Traditional banks aggressively market their checking accounts as free, but if you look closely at the math, that promise is a carefully engineered illusion. The Consumer Financial Protection Bureau, or CFPB, a U.S. government agency that regulates consumer financial products, has launched an ongoing investigation into how financial institutions generate billions of dollars from hidden penalties. This vertical bar chart compares the average annual cost of a traditional checking account against a true zero-fee online account. The average maintenance fee costs a customer about $188 a year, and that excludes the standard $35 overdraft charges. Regulators don't view these junk fees as accidental penalties. They see them as a core business model designed to extract revenue from low-balance customers. The traditional banking model subsidizes its massive infrastructure by setting financial traps for vulnerable customers, turning a supposedly free account into an expensive liability. Most people dread the process of migrating to a new bank. Instead, they try to outsmart their current institution without actually moving their money. One common approach is the negotiation route. This means calling customer service or using third-party apps to ask for a fee waiver. Negotiation fails as a reliable strategy. It requires a long account history, wastes hours of your time, and relies entirely on fluctuating generosity. Then there is the complex automation route. Customers try to set up complex minimum balance alerts and carefully route their direct deposits to satisfy the fine print requirements. Trying to beat a traditional bank at its own game requires constant vigilance and high effort for very little reward. The only permanent solution is to migrate to a completely new model. Abandoning these fees means abandoning the physical convenience of traditional banking. The primary draw of the legacy bank is ubiquity. They offer physical branches in your neighborhood and frictionless ways to deposit physical cash. That convenience is paired with a brutal fee structure, heavily reliant on massive, surprise overdraft penalties. The polar opposite of this system is the pure fintech route, utilizing digital platforms like Chime or SoFi. This 4x4 matrix compares traditional banks against pure fintechs. Fintechs offer absolute zero maintenance, no NSF fees, penalties for declined overdrafts, and built-in buffers. The severe trade-off is total loss of branch access. Depositing physical cash involves heavy friction, like paying retail pharmacy fees. Fleeing to a pure fintech instantly cures the junk fee disease, but it amputates your ability to interact easily with physical currency. There is a middle ground option for users who want zero fees, but cannot let go of physical banking infrastructure. This brings us to the hybrid bank model, like Capital One 360. Hybrids eliminate the baseline predatory fees. They wipe out monthly maintenance charges and eradicate overdraft penalties. They also retain selective physical infrastructure, offering specialized cafes and proprietary ATMs that still accept physical cash deposits. The geographical catch is that these physical locations are highly localized. They offer zero utility if you do not live in a major metropolitan area. Hybrid models offer a safe harbor for the digitally hesitant, but only if your daily life happens to fall within their limited geographic footprint. Heavy travelers face a completely different category of junk fees. If you frequently use out-of-network ATMs, you bleed roughly $5 per transaction. The solution here is the premium digital route, utilizing institutions like Charles Schwab or Ally Bank. This world map highlights their standout feature, unlimited global ATM fee reimbursements, effectively turning any machine on Earth into an in-network ATM. The hidden requirement is ecosystem integration. You are often forced to open linked brokerage accounts, committing to a complex financial ecosystem. Securing ultimate geographic flexibility and eradicating ATM fees requires you to manage a significantly wider financial footprint. A universal perfect bank does not exist. Selecting an account is a process of calculated elimination based on your real-world habits. This branching flowchart illustrates the baseline filter. Do you deposit physical cash regularly? If yes, follow this branch directly to hybrid banks or credit unions, eliminating pure fintechs. If no, move down to evaluate your travel and out-of-network ATM usage. Tipped workers and small business owners will severely disrupt their workflow if they attempt to use a pure digital bank. Cash is too central to their income stream. Your specific employment type and your relationship to physical currency dictate the foundation of your banking choice. These factors override any digital perks. Consider the margin-squeezed user, the person whose entire week is derailed by a single $35 overdraft charge. We direct these types of users firmly over to the pure fintechs, where balance-triggered penalties are mathematically impossible. Then there is the set and forget optimizer. This is the user who prioritizes global access and high yield over extreme simplicity. For them, the premium digital tier makes the most sense to maximize their geographic flexibility. Every single zero-fee account requires a specific compromise of convenience. You have to give something up to escape the fees. The goal is not to find a flawless institution. The goal is to choose the bank whose specific limitations do not bother you, permanently cutting off the junk fee drain.